They said silver was finished at $55. Then a Thursday morning jobs report arrived, and this market did not just react. It reversed hard, and it's still turning right now, while most people are sleeping on it. I'm John O.G. Asian Guy. Quick heads up before we get into this because it matters for what you're about to hear. This week's Members Playbook breaks down exactly what happens next for ETF holders, physical silver holders, and physical gold holders separately. 3 completely different setups, depending on what's actually sitting in your portfolio right now. I'll circle back to that once you've seen why it matters. Here's where we actually stand. Markets have been closed since Friday. Yesterday was closed for the holiday. In a few hours, when New York opens, this entire jobs report reaction gets its first real challenge. And Shanghai has already shown us something important while everyone else was on break. So let's build this properly piece by piece because there's a lot more moving right now than one number on a government report. Start with the trigger because it's genuinely one of the sharper shortfalls we've seen in months. The June jobs report came in at just 57,000 positions added. Economists were sitting at a consensus near 115,000. That's not a soft miss. That's less than half of what the market was pricing in. Now here's the part almost nobody described properly when it happened. April and May didn't just look weak in hindsight. They got adjusted down too by a combined 74,000 jobs. So this wasn't one bad Thursday. It was 3 straight months quietly weakening underneath a labor market everyone thought was still fine. This is not some random accident sitting on top of a random Thursday. This is the kind of data print that forces a room full of traders to revise their entire rate outlook before their coffee gets cold. April and May didn't just look weak in hindsight. They got adjusted down too by a combined 74,000 jobs. So this wasn't one bad Thursday. It was 3 straight months quietly weakening underneath a labor market everyone thought was still fine. This is not some random accident sitting on top of a random Thursday. This is the kind of data print that forces a room full of traders to revise their entire rate outlook before their coffee gets cold. Here's the mechanism, and I want you to actually understand this instead of just nodding along. Weak jobs data means less pressure on the Fed to raise rates. Silver pays you nothing for holding it. So when rate hike odds fall, the cost of sitting in silver instead of a yield-bearing asset falls with it. Money rotates back in almost mechanically. Within hours, odds of a hike at this month's meeting dropped beneath 30%. September hike odds fell from around 66% down to 51%. That's a full revision of the forward curve off a single data release. The dollar declined too, sliding toward the 100.87 level on the index. Weaker dollar, cheaper silver for anyone holding a different currency. That's a second tailwind stacked directly on top of the rate story, not a separate one. So, what actually happened to price? Silver, which had been sitting in the high 50s, leaped as much as 3.8% intraday and broke through $61 almost immediately after the report crossed the wire Thursday morning. By Friday's session, spot silver was trading near $62.70, with futures touching $63.50 intraday before some of that spike faded back. Spot gold moved in tandem, climbing over 2% to trade above $4,100. Here's the figure that should actually stop you for a second if you're serious about this market. COMEX registered silver, that's the physical metal sitting in approved vaults that's actually available for immediate delivery against a futures contract, sits at roughly 92.88 million ounces as of the most recent reading. That's up nearly 15% over the past 30 days. Total combined stocks registered plus eligible sit around 323 million ounces. Read those two figures next to each other. The metal backing this market didn't shrink during the crash to $55. It expanded. That is not what a market running out of silver looks like. That is a market where physical supply was quietly repositioning itself while paper price was doing something completely different on the screen. Let's slow down on that COMEX figure for a second because most channels will throw it at you without explaining why it actually matters. Registered inventory and eligible inventory are 2 very different categories sitting inside the same vaults. Registered metal has already gone through the process of being certified and warranted, meaning it can be delivered against a futures contract today immediately, no extra steps. Eligible metal meets the exchange's purity standard and sits in the exact same building, but it hasn't been formally warranted yet, so it can't move against a delivery notice until its owner takes that additional step. When registered stock climbs the way it just did, from roughly 87 million ounces during the worst of the crash up to nearly 93 million now, while total combined stocks barely moved, that tells you metal is being actively converted from eligible into registered status. In plain terms, owners of that silver made more of it deliverable right as the price was falling apart on paper, not less. That is not the behavior of people who believe the bottom was actually falling out of this market. That single detail alone is worth considering before you decide what this bounce actually means. Now timing. This is the piece that gets compressed into a soundbite everywhere else. So let's actually walk through it properly. The jobs report hit the wire Thursday morning before the New York Open. Silver's initial spike happened in the first hour of trading, that 3.8% move. Then, because Friday was a shortened pre-holiday session heading into July 4th, and the 4th itself was a full closure, this entire move got frozen in place for almost 48 hours. No new catalyst, no fresh data, just positioning sitting there untouched while everyone else was away from the desk. That's genuinely unusual. A market doesn't often get handed a shock catalyst and then get 2 full trading days to sit with it before anyone can react further.